I think that market consensus is pretty accurate. My base case would be 25 basis points, wouldn't be shocked by 50 basis points. And what the Fed tends to do is they tend to send speakers out with statements that kind of shift the market's perception that, if the market was over expecting 50 basis points, while the Fed was expecting probably 25 basis points, they'd probably start sending out some slightly hawkish speakers, and vice versa. If the market wasn't expecting 50, and they were intending to do 50, they probably would start sending out more dovish speakers. So for these near-term cuts, I would expect, that the market pricing is fairly accurate. I think we're going to see a mild set of cuts coming up. So there's been a number of analysts, including myself, that have noticed that for the past 2+ years, there's been a big gap between the household survey and the payroll survey. Basically, if you ask people what is their job situation, and if you ask businesses what is the job situation, there's been a wider than normal gap between them. One of them counts basically people that have multiple jobs, the other one doesn't, different sources of reporting, and they showed bigger than normal divergence. And that can be chalked up for a number of reasons. The post-pandemic economy is a little bit structurally different. There's more work from home, there's more gig work, there's more piecing together multiple types of income sources. It's also not always clear the immigration numbers in a given year and how that can impact job markets around the margins. And so I think that those factors added more uncertainty than normal compared to what they had, kind of prior to 2020. So this is not like a big shocker in many ways. It kind of brought down the top level estimate down to somewhere kind of in the middle between those two estimates. And shows that the economy was softer than was expected. Even before the revision, the official unemployment rate had risen from 3.4% to 4.3%. And historically, when the unemployment rate rises by that much, it doesn't usually stop. It usually keeps going into a recession. It doesn't mean it has to happen every time, but the Fed is very aware of that historical trend, which is why they're not really fine with further softening in the labor market. If you look at their projections, they tend to project what they think unemployment is going to be, a year by the end of the year, by the end of next year, and this kind of rapid increase to 4.3 already hit kind of at or above their median expectations, even looking out to next year, the end of next year. And so the fact that it's now at the high end of their expectations kind of shows that their mandate is shifting. And one could back up and say, should the Fed even have a mandate? Like, we generally don't think the price controls are a good thing. Should they control the price of money, right? So there's kind of philosophical discussions around what the central bank should even do. But given what he's officially mandated to do, which is balance unemployment with inflation, and there's other shadow parts of the mandate. They call it a dual mandate, but also maintaining stable long-term interest rates is part of the mandate as well as unofficially maintaining financial stability. So as he kind of balances them all together, he's more concerned, or at least equally concerned, with the unemployment rate continuing to rise compared to inflation not necessarily falling down to the target as fast as they'd like to. So they're kind of stuck, on kind of both sides of the mandate at the same time. I think it mostly comes down to whether it's surprising. If we get the 25 basis point cut, the market's already largely priced that in. And long-term rates are well below. I mean, they priced in multiple cuts in the quarters ahead. So I don't think a 25 basis point cut would be particularly substantial. It's possible you get a little bit extra kick out of 50 basis points, at least on current pricing. But a rate cut of that magnitude, I don't think is particularly impactful for either equity markets or the economy as a whole. Well, so the revisions themselves, they weren't from the Fed. They were from, the executive branch. And so, yeah, there's always a possibility that games are played there. That's not out of the question. The models themselves are flawed in the sense that they have all these assumptions built into them. Like they have a natural kind of guesswork for how many businesses are created or die in a given period, and then they have to kind of go back and revise that retroactively. It's actually fairly common kind of during or shortly before recessions for multiple quarters of data to be revised down because a lot of it is just kind of projecting what's already happening. So this can happen without intent. It's just bad, top-down economic models of a 330 million person economy are kind of in some ways silly to begin with. there's some metrics are actual numbers. Like for example, jobless claims that come out, those are actually counting what's happening, whereas these other things are kind of a combination of counting and projecting. And so all those projections are inherently flawed. And then from the Fed's perspective, right? So they're not the ones compiling that information, but then they have to respond to that information. If they were in a position where the data now, at least according to their model, if they're supposed to kind of soften interest rates based on the data at hand, but they don't because there's an election coming up, that actually would be somewhat political. So it's kind of a mix. It's almost like they should, in theory, put blinders on and just operate like basically there's kind of a centralized algorithm that they're supposed to operate. Now you could say that the algorithm is flawed, right? That interest rates aren't really the primary lever here anyway, that they were too late to raise rates against inflation. People argue that they're either too soon to cut rates or too late to cut rates. All sorts of, I'm not really a fan of central bank interest rate management anyway.
Right.
But given the fact that that's how it's done, I mean, if you're given, unemployment rising from 3.4 to 4.3, and you have official inflation measures fall from 9 to 3%, mild rate cuts, kind of reducing the real rate makes sense. You wouldn't want a big interest rate cut before the recession. 25 basis points wouldn't be much. Jerome Powell is a registered Republican, but the majority of Fed officials tend to be Democrat-leaning. But I wouldn't particularly categorize this Fed chair as particularly political. I think he's more worried about his long-term reputation. But these kind of things happen, and it's you can chalk it up to maliciousness, you can chalk it up to incompetence, but there are serious issues with the data, and I would say with the entire model of a centrally governed interest rate to begin with. Right, and so going back to the prior point, one of the things I did in the book Broken Money was I was very critical of central banking in general. So they when the economy is going strong, they start to raise interest rates until they kind of pressure it. And then when it starts to blow up, they cut interest rates and they try to reinflate the next credit cycle. So they're kind of, in theory, supposed to be a counter-cyclical force, but in practice, they end up being a lagging pro-cyclical force. They contribute to booms happening, and then they're unsustainable. And then they contribute to popping the booms that they themselves caused. And then they try to reflate the bust that came from the boom that they broke, right? So it's just kind of this repeated cycle of putting out fires that they themselves at least partially started. I'm fully critical in that sense. And as far as how assets should react, I mean, basically they tend to react in a delta to what happened versus what is expected. So if the market is but as we get close, so those probabilities for what's going to happen in September will be more and more locked in. And then when the event happens, if it's what they expected, I wouldn't expect particularly explosive asset price changes that week or that day. But if something deviates significantly from what they expected, we could see, if they cut more than expected, we'd probably see a bigger jump in gold, potentially Bitcoin, than what was priced in. So I don't specialize in these kind of multi-week or multi-month trading ranges. Right. I'm structurally bullish on gold and Bitcoin. And then when it comes to equities, it really depends on what sector, what jurisdiction of equities, what valuation. So there's some types of equities I'm quite bearish on. There's some types of equities I'm quite bullish on. And I think we're probably going to see rotations in the quarters ahead. But I wouldn't read too much into any one rate cut period.